This is Golden Years, a roadmap to navigate retirement with Mark Cordner, the podcast.
Good news, stock prices are testing all-time highs. And some big names like Amazon's Jeff Bezos, Mark Zuckerberg of course, Meta, and the Walton family of Walmart, they've recently sold off millions of dollars of their company's stock. One analyst tells Fortune magazine that the cash out could be due to the election, possibly shaking a few things up, maybe leading to a downturn in share prices in the next few years. So again, while things are looking great at an all-time high, they are selling items off, which might lead some to think that there could be a market crash around the corner. What are your thoughts?
Yeah, I have to chuckle a little bit, though, when I hear these commentators who are trying to draw a direct correlation to an event such as the election. I think the best thing we can do generally is ignore these media pundits because they're always trying to connect two dots that may or may not be interrelated. Sure. We're in such a globally interconnected environment. But what I love about this observation you've made with people stepping back from their stock positions is that all of us have these opportunities. We know that the market's going to go up and down. We know we're going to be overvalued. There's going to be corrections. That's just the nature of the market. It's like the ocean. There are waves and they go up and down. But the key thing is that these people are making changes to their portfolio. We don't have a bird's eye view of their portfolio, but we do have a bird's eye view of our own individual holdings. And with that in mind, I always recommend that people look at their holdings and their portfolio and decide, does it still make sense? I made decisions years ago. Do they still make sense to stay where I'm at? And for many people, particularly as they're aging and approaching retirement, they find that they want to be perhaps less exposed to the market. And so we see people pulling out of that into principal protected accounts, which I love because it falls in line with what I call a two-pocket philosophy. When the market's down, we want, and if we need money, for example, in retirement and the market is down, that's a great time to reach into a guaranteed safe, principal protected pocket, which buys time for the market to recover so that when the market's up, then we pull money from those accounts. We need to have money that's in the market so that it can offset inflation, but we also need to have money that's protected from the market for when those times when the market's, squirrely. And so this two-pocket approach or multi-pocket philosophy, I think, is very wise. It's prudent for people. And that's what I see when I hear about things like Jeff Bezos and the Walton family making changes. I just see them being prudent. I don't know what they're doing with their money, but they're making changes and they're pulling some of it back, which I think is what most of us can and should be doing as we get older.
Well, I was just going to say, they always say, if you want to be wealthy, do what the wealthy do. So when you start seeing these big names start making moves, you yourself as the average Joe start saying, well, wait a minute, should I be making changes in my portfolio? And wait, do they see something or know something I don't? Is, a market crash going to happen around the corner? What's the best way, I guess, and you touched on this a little bit here, but what's the best way to, dabble in the market a little bit and capitalize on the upside, but then also protect ourselves from a potential crash?
Well, there needs to be a principal protected element, I think, to most every portfolio. We need to have money in the market so we can outpace inflation. So it needs to be this two-pocket approach. But the key thing is that it's not the right answer for everyone to follow particular trends. We don't know what's going on inside of Jeff Bezos' portfolio or his mind or Mark Zuckerberg's, but we do know what our needs are. And it really boils down more than anything to timelines. Each of us have different timelines as to how soon we're going to be retired and have to depend upon our portfolio for income. So it's not always about growing the portfolio, which is a big lesson that my generation needs to hear. We spent the last 20, 30 years with these sexy market returns, and everyone got stung a bit in 2008 and recently, and it's caused them to rethink. It's not always about having the biggest pile of money. It's about how much income can that pile of money create. It is going to have to be converted from an asset into an income-producing resource. And retirement is all about risk management, and it's all about income. I've met with people who have just a ton of money in real estate. It can be land or other non-income generating holdings. So they have wealth, but they don't have income. Or the more commonly for most Americans is they have all this money tied up in their homes and they don't have any retirement savings. So they either need to downsize or refinance or maybe do a reverse mortgage. There's a variety of things they can do, but they have money, they have assets, and they don't have income. So when we're dealing with people, we're looking at income. How can you have the income to be independent and have the assurance of groceries during those later years when you can't go back to work? That's what we do for people, is help them be secure, help them have that confidence that they need to go into the future and not have to work the 60, 80-hour weeks, but maybe they can scale back to 20 or 30 hours, or maybe they can stop working entirely.
The Fed, gosh, I hope somebody knows what they're doing up there because, lots of folks on Wall Street still hoping for an interest rate cut this year. But even some of the members of the Fed have hinted that it's actually going to go the other way. Here's economist Lindsay Piegza on CNBC.
If we see inflation continue to rise away from the Fed's 2% target, they will be backed into a corner and forced to potentially raise another 25, 50 basis points or more, depending on how precipitous the backup in inflation becomes.
So the fact that she even hints that the Fed could go up even more makes me I can't even understand it. My head wants to explode. The Fed, I think, is really raining down on all of us here. So how do you think the markets will react if the Fed does raise rates? And I guess bottom line, how are you helping your clients be prepared for all of this?
These are all great questions. I tend to agree with Lindsay. The truth is that raising rates is the means of reining in inflation. And so inflation hasn't slowed down as much as we've wanted. And therefore, I personally haven't believed that rates are going to be able to be cut here in the near term. In the short term, they're going to have to either stay the same or potentially go up the way that she's saying. But the silver lining in all of this is the old maxim that we use here, the expression in our industry is that when mortgage rates go down, we refinance our mortgage. When mortgage rates go up, we refinance our retirement. So if you haven't looked at your retirement accounts recently, and particularly some of the interest-bearing products or those that are more interest sensitive, you ought to do so because there's been some tremendous improvements. I mean, just this morning, I was looking at a case for a client where they would just downsize, actually. That seems to be a theme this morning. But anyway, they're looking at generating money off accounts we set up 4 or 5 years ago. And I realized while looking at those accounts that because of these recent interest rate increases, we can actually switch them to other products that will guarantee them the lifetime income benefits, the private pension that they need to now close the gap between their Social Security and, in his case, a small union pension. So they need a little bit of extra money, another $1,000 a month, and we can show them how to do that, but less expensively than we thought 4 years ago. We can basically refinance into these new products that are now paying out more and that will guarantee him income, that lifetime income benefit assurance that he needs to sleep well at night. So yeah, if you haven't reviewed your accounts recently, come visit with us. Let us show you how some of these opportunities have improved here just in the last year or two. It's not all doom and gloom. When bad things happen, good things also happen. We just got to look through the cloud to the silver lining. It's there.
Investment advisory services offered through Golden Years Financial LLC, a registered investment advisory firm. Insurance is offered through Golden Years Insurance Services. These firms do not provide legal or tax advice. Consult your own legal and tax advisors before taking actions that may have tax implications. Investing in securities involves risk, including the potential loss of principal. Insurance contracts principal protection is based on the claim-paying ability of the respective insurer. None of the information contained on this website shall constitute an offer to sell or solicit to buy a security or insurance product. The information and opinions contained on this site or requested from this site are provided by third parties believed to be reliable, but accuracy and completeness cannot be guaranteed. They are provided for informational purposes only and are not a solicitation to buy or sell any of the products mentioned. Any media logos and or trademarks contained herein are the property of their respective owners, and no endorsement by those owners of Mark Cordner, Golden Years Financial, or Golden Years Insurance is stated or implied.